Let's ask Truist Wealth CIO Keith Lerner and Empower Chief Investment Strategist Marta Norton, who joins us here at Post 9. Good to see both of you. Thanks for coming in.
Yes, my pleasure.
What do you make of, I guess, tech lagging, a little more volatility? This comment from the Fed chair, you don't get that every day about valuations in equities.
Right. And, I think it really is a sign of how extreme valuations are. We all know that valuations aren't a timing indicator. Markets can grind on for quite some time. But what we do see in the data is when valuations get to extremes, whether that is extremely cheap or extremely expensive, that's when they become more predictive of prospective three-year returns. And so I think that's something we're all circling around.
Your general take vis-a-vis the Fed is that the market tends to always get its hopes up on the pace of rate cuts, and this one might not be as dovish as some in the market think. Is that right?
Well, it certainly has been the case over the past several years that the market has tried to anticipate, tried to push cuts, and the Fed has held back. And I think we're seeing a little bit of that dichotomy today. We're seeing the market price in rates that would effectively take rates below 3% by roughly this time next year, whereas the Fed is being a little bit more, or less dovish in that regard.
Right. Keith, that's definitely been, we've gotten a mix of Fed views over the past, say, 48 hours, but Hammock yesterday, Bostic, there's some hawks out there, and they are clearing their throat a little bit this week.
Yeah, well, first, great to be with you. What we're seeing is that for the Fed, it's complicated, right? With the inflation backdrop, retail sales was a little bit stronger, and they have scar tissue from what's happened, a few years ago with inflation. But, our big picture as we look at the work call is when the Fed has cut rates historically, near all-time highs, and you look forward a year as a starting point, the markets have been up about 90% of the time. What's important is that we don't go into recession, that the economy continues to move forward. And then I would also say, though, that, interest rates are important, but they're not the only thing that matters. Look at this market this year. We're up double digits, and the Fed only cut just recently. The North Star for this market, the most important driver, especially given those higher valuations, continue to be earnings. And I think that's what we'll continue to focus on. Our bottom line is we think the bull market deserves the benefit of the doubt. We'll likely get some consolidation after this big run-up. But as you move into the fourth quarter, strength tends to beget strength, and we think we ultimately end up higher.
I wonder what you make of September month to date here, Keith. Thanks to Bespoke, we're on pace for the best September since 13, up almost 4% for the month. And I wonder, does that sort of signal a would-be chase among real money going into the last quarter of the year?
Well, I think the market likes to fool the masses, right? I think, if you look back at the seasonals, August and September are typically weaker. We haven't seen that. And even think about tech and communication services this month, up 6 and 7%. So I think what that likely leads to is more of a consolidation as we move into October, and because we didn't really get it before. And we have higher expectations as we move into the fourth quarter. So I don't know if there will be an immediate chase call because we do have higher expectations. We have moved a long way. But I think as we kind of move through the next quarter and as markets start focusing on 2026, a little bit better economic backdrop, a little bit more clarity from the one big beautiful bill, a little bit more clarity, hopefully, on tariffs and some rate cuts. I think that the market will have additional gains, but we might have to have a little bit of choppiness before that happens in the fourth quarter.
Now, speaking of choppiness, another great stat today is that S&P index price action has gone the opposite way of breadth. I think 60% of the sessions so far this month. Normally that number is much, much lower. And it does sort of tell you about some of the churn that's happening beneath the headline level, right?
It's so interesting because when we think about this market, of course, technology comes to mind, the Magnificent Seven, the AI A-list, all of those stocks come to mind. But there has been strength elsewhere, maybe not quite to the same degree as earnings, but we have seen strength from financials, from industrials. So it hasn't been just a growth-only market. And I think that's to the benefit of investors. But it also means that there's fewer opportunities, and from a valuation perspective, at least out there in the markets today.
Right.